Hello everyone, welcome to today's US Live Open. It is Thursday, March the 7th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Of course, it is a week that has many high-impact events, and just earlier, the European Central Bank announced its latest policy decision, keeping rates steady and at the same time lowering its inflation forecasts, now expecting the 2% target to be reached next year, and also downgraded its economic growth outlook. Yesterday we had Chair Powell staying hawkish, but markets reacted positively as it did not provide any surprises. Of course, we also have gold hitting new record highs, and we have sustained fears around regional banks, bank on 1 year from the 2023 SVB collapse. So these are some of the key topics we will be discussing today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. I'll give you a few more seconds to read through, and then we will begin. Okay, let's get the ball rolling. You can see on the left the euro dollar, which dropped right after the policy decision by the European Central Bank, but covers these losses as President Lagarde's press conference is underway. And on the right, you can see the DAX, which gains after the decision. So what did we get today from the European Central Bank? Rates remained unchanged for fourth straight time. The wording did not change significantly. Officials repeated that current rates maintained for a sufficiently long duration will help restore price stability. But what we had were revised projections, and policymakers lowered inflation forecasts to 2.3% for 2024, and now see it hitting the 2% target next year earlier than previously. At the same time, they downgraded the 2024 GDP growth to 0.6%. So those things taken together, we saw a dovish reaction in markets because this sort of raises prospects of a rate cut, a pivot by the European Central Bank. Later in the Q&A, which is still underway, President Lagarde said that Europe is in a disinflationary process, but she also said that she's not sufficiently confident about she's confident but not sufficiently confident about hitting the target, and that the bank is not there yet. So it did not declare victory, and it did not entertain any rate cut scenarios, at least as far as we were able to hear it before we start our session. That is why we saw the decline initially, and then the increase of Euro USD, which covers its losses. So that was what we have so far from the European Central Bank. Now let's turn to the euro dollar on the 4-hour chart for our technical analysis. Before we go though into that, let's talk about what we had yesterday from the Fed. As we have already discussed, the US Central Bank has then turned cautious around removing monetary restraint as inflation shows persistence, the economy outperforms, and the labor market is strong. In his first day of Congress testimony yesterday, Fed Chair Powell stayed on course, saying it will likely be appropriate to begin cutting rates at some point this year, but wants to see a little bit more data before doing so. He largely reiterated previous remarks and leaned hawkish, but did not surprise markets, and the greenback came under pressure, thus sending euro-dollar higher. Now, technically, not much has changed. The pair has done significant progress after the reaction to Chair Powell's comments, which was negative for the dollar. It has moved above the 38.2% Fibonacci, and this brings 1.1017 in the spotlight, but it is still a difficult technical path, mostly due to the falling daily Ichimoku cloud. And although the European Central Bank is more hawkish in terms of rhetoric compared to its US counterpart, it is probably a better candidate for a pivot given the weak economy. As such, there is still risk for a return below the 200 period EMA at around 1.0830. But of course, the February lows are distant at this point. Of course, the trajectory of the pair will depend on key incoming events. We expect US employment report tomorrow. The last print had shown the biggest addition of jobs in a year, and markets remain somewhat hot despite coming into better balance. Chair Powell yesterday softened his wording a little bit, saying that the labor market is relatively tight. Another hot print, of course, could sap market expectations and boost the greenback, while low figure could bolster rate cut optimism and drive the currency lower. On Tuesday, of course, we expect CPI inflation from the US, which has come down substantially. You can see it here. From the 2022 multi-decade peaks, but remains above the 2% target. On the left, we have headline inflation. On the right, we have core inflation. Chair Powell yesterday said that inflation has decreased notably over the past year, but remains above the central bank's target, and said that ongoing progress towards the 2% inflation target is not as would. So he's not ready to call it a day yet. Now let's go to the US dollar versus the Japanese yen. It retreats notably. Of course, the the key catalyst was Chair Powell's speech yesterday, or actually the market interpretation of it, we would say. And as markets now contemplate prospects of a policy pivot by the Fed and the Bank of Japan. As we said, Chair Powell's speech reinforced optimism for cuts, but the Bank of Japan is likely to move first, of course, in the opposite direction. We have talked many times about the policy differential here. The BOJ has hinted to the end of negative rates, and this could occur as early as the next meeting, which is in 2 weeks, or in April, which seems a little bit more likely, as officials may want to wait for the outcome of the wage negotiations. However, there is uncertainty and thus risk, as the Bank of Japan has stayed on the sidelines and has been reluctant to pull the trigger so far. The pair slumps this week, as we said, because market digests pivot prospects by the central banks. It moves below the 200-period EMA and the 23.6 Fibonacci, which exposes it to the 38.2% level and the February low. These highlighted areas on the chart. On the other hand, this confluence of supports along with the daily Ichimoku cloud can contain the drop. We're already seeing an effort to stabilize. And of course, if we take a look at the relative strength index, it is extremely oversold, also pointing to a potential reaction here. The correction so far is shallow, and it will remain shallow above the 38.2% Fibonacci. And we can see the greenback retaining above the 200-period EMA at around 149. But this would reinstate the bullish bias, but taking out the highs from 1990s at 152.20 becomes increasingly harder. Now let's switch gears and talk a little bit about gold. We discussed about it on Tuesday. Now it did hit new record highs and brings the next level at 2,180 in its crosshairs. But there are key events ahead, as we discussed, that could shape its trajectory. From a technical perspective, it is, if we take a look at the relative strength index, it is again extremely overbought, hit 90, and we can see that the RSI has not climbed higher highs and has not followed the price higher. And if we look at the hourly chart, there is a clear disconnect, a clear divergence there. You can see here how the RSI diverges from the actual price action, and this is a potential indication for a pullback. Back to the 4-hour chart now. Any such pullback could lead back towards 2088, but strong catalyst would be needed for further correction that would target a significant confluence of supports provided by the 200-period EMA and the daily Ichimoku cloud. And with 4 minutes into the US session, let's talk about the Nasdaq, and then I want to talk about the regional banking fears that are sustained. But in regarding to the tech-heavy index, after good enough inflation last week, this week we have good enough Powell testimony. He maintains a hawkish stance, but it was benign, and as it would say, and offered nothing to surprise markets, and they cheer this testimony essentially, and the Nasdaq is on track to set new all-time highs towards 19,000. On the other hand, given this reserved approach by the Fed, we could see renewed pressure and a test of the 200 period EMA, but bigger losses towards and beyond the February lows have a higher degree that could determine the next leg of the move. And now I want to round things off with the New York Community Bank Corp, the regional lender who has been facing difficulties this year. We have talked about them before recently, but let's also offer a timeline. And this, of course, comes just a year after the Silicon Valley Bank collapse, which had rattled markets and especially regional lenders. Now, on the left, you can see the chart of the New York Community Bancorp's stock. It had announced a rare net loss of 260 million due to higher provisions for credit losses during the Q4 results at the end of January. And you can see the massive drop in the stock. And of course, it had slashed its dividend in order to build up capital. And of course, the regional banking ETF, the KRE, had also dropped then. NYCB had grown substantially after acquiring certain assets of the failed signature banks during last year's SVB crisis, and its assets exceed the 100 billion threshold that comes with increased regulatory requirements and made it one of the 30 largest banks in the US. That, of course, create the need for higher capital reserves and stronger balance sheet, and the regional lender clearly struggles with that. Furthermore, banks like this one are exposed to commercial raised real estate loans, and more than 13 billion in such loans. The bank had more than 13 billion in such loans at the end of last year. And of course, the commercial property sector has taken a hit from higher interest rates and the work from home realities. Markets, of course, are afraid that not all of those loans will be repaid. Now, despite the bank's efforts to address those issues, problems did not stop there. The bank identified material weaknesses in its internal controls and announced a 4 billion impairment charge for the fourth quarter, and changed its leadership last week, and the stock took another dive to, you can see on the left, to new 3 decades lows. And of course, it was a very volatile yesterday on news that it was trying to raise equity, but covered those losses and opens higher today after it secured an $1 billion influx. Now, of course, as we said, these problems comes 1 year after the SVB collapse and sustained fears around regional lenders in the US, but the problems seem to be quite particular to this certain bank, specific bank, and furthermore, authorities have shown that they can act quickly to contain spillover if it comes to that. And that is why, if we look at the right on the regional banking ETF, after the first drop, it has been relatively muted in the last 2 incidents. Of course, we need to monitor the situation. It doesn't seem like things are as risky as a year ago. And although reserved towards cutting rates, the Fed is looking to lower them this year, which will likely help. So that's it pretty much from me for today. Thank you for joining me.